All right, Citigroup. So here's another banking earnings report that we got that came in, and it's coming in better than expected, as always. The revenue is not much of a change. Um, this similar to JP Morgan, the earnings on market trading has improved, which is good, and currency and commodity trading. So the banks have been making some new profits on trading activity, which is helping their numbers a bit. And Citigroup did not post a number for the amount that they're putting into their funds for loan defaults. So we saw a huge number from JP Morgan preparing for a bunch of defaults. And the big number here is minus 74% on earnings, which this is a monstrous down number, but then again, also much better than expected, apparently. So yeah, basically, they're taking big losses on credit, on loans, and so defaults, and then lending revenues are the main are the main driver of this, minus 74% earnings. And then Citibank has not made a statement on any kind of an outlook or the safety of their dividends. So this stock is looking weaker than JP Morgan, and I would expect most of the bank stocks are going to come in looking about like this. This is not awesome. Here we go. Citigroup, and C is their ticker. Yeah, so Citigroup has a pretty average looking kind of chart for the financial sector. And then if we get in on the action today, that's a pretty bad earnings report, and it didn't get the pre-market kind of move up that we saw in JP Morgan. We saw the whole financial sector kind of move up leading into the earnings reports, and now that we're getting them just kind of weak. And yeah, we'll see. We'll see. They should be weak. They should be weak. It's been in a bit of a bearish trend here for a while, and I don't really know how this sector could be doing that well, even before these earnings reports came in. Um, but yeah, every report is going to say it's better than expected, but still, it's like minus, what was it, 74% earnings. So, so yeah, we'll see. We'll see if the kind of earnings fundamentals start mattering or not. Like, because nothing else is really changing right now. Like, the dollar's not breaking down yet. The bond yield curve is starting to flatten out a little bit, which is not super positive because it's flattening out closer to zero. But it hasn't started to break down or up really. So we haven't seen a break in inflation indicators and the interest rate indicators. But as for now, the interest rates are weak. The Fed balance sheet is still going down. The the Treasury General account probably won't have too much of an effect on the financial sector, but yeah, the Fed bond trading, like these banks are not on the bond buying list, the individual bond buying list, and the low interest rates are very bad for their general revenue streams. Although we are seeing the banks rotating into market trading activity, raising credit card rates, so they are making money in some different ways, but it's not making up for the massive losses in the general lending with the super low interest rates, and then also all the defaults that are coming in are going to cost them a ton of money. So the banks are just preparing huge funds of money just to lose as they have defaults come in over the next year or so. So yeah. So as for now, it's a really bad environment for financials, and the charts are pretty weak, reflecting that. And the earnings reports really are not a surprise. So I guess if they came in worse than expected, then a big down move might be a thing to expect. But everyone knows that these are going to be some really bad numbers. So As of right now, I mean, we're not seeing much. I mean, it's still just trending in the same kind of zone. I guess if you want to draw sort of a technical kind of setup on here, it could look like it's trying to break out, break out of this kind of zone here right now. So, I mean, we have pretty strong resistance overhead with the moving average that rejected hard here, and to the bottom side, this isn't. It's not really a. It's not really a triangle, um, but yeah, we'll see. We'll see if it can find some resistance and hold here, and see if it's trying to hold up or not. This should be a resistance area, even on kind of a horizontal kind of setup. So, I mean, as it stands now, it doesn't really look like the financial earnings reports that are coming in are doing much to move the stocks. Citigroup looks a little bit weaker than JP Morgan did, but it's nothing too crazy. Let's see what the S&P is doing. So, as far as the financials go, um, I'm I'm pretty bearish on the financials overall, but it doesn't really look like they should be breaking down hard like right now in the short term, unless the whole market wants to move. Then the financials should like lead. Like it should be the Qs that are way uh, overpriced leading the market. If those start coming down, the financials are kind of one of the weaker sectors that should be moving down with it. But as far as a big move down, like we need to see the Qs actually break down, which they have pulled back a little. So we're just kind of waiting to see. We're waiting to see if the dollar wants to break down, if the bond yields want to break down, if the Qs want to break down. There's a bunch of things that are set up that could break soon, but they haven't broken yet. And so then here just on the S&P, I mean, we've had this trading zone that we've been wobbling around for quite a while here. I've been calling it the boring zone. And then we started to get out of the top side of this. And so it looked like we were going to get a bullish setup here and then it broke down and we didn't get it and then it's wobbling. And then it looked like we were going to get a bear setup here because we broke down and we got a little bit of a back test, but it completely held above this level and shot right back up. And then this zone where all this action happened is dead parallel to the previous top back here. Yeah, so you can see the level here, 31.86 and 32.33. That's right. That's right where we are reacting here. So you can see it kind of bounced off of the bottom of that island top area and then rejected right off the top of it. And it didn't just do a weak rejection. It shot all the way back down underneath this, underneath this trend line that we've had going for a while. And so now we want to see if we're going to get a bearish setup or not. I mean, we just bounced off of the support again, and now we're up underneath this one. So, I mean, really to get a bearish trade with actual bearish momentum and a technical setup at the same time, we just need to. I mean, we've already broken down. We've already kind of back tested now. If this acts as resistance, we just need to break down below this area here. And then from that point, there's very little resistance until you get down here to the long-term moving average and these long-term support lines. That this is a 12-year support line that supported the whole bull run off the 2008 crash. So as far as a bearish move, like this is a technical spot where it should actually make a bearish move. If it breaks down here to like 3,115 in the next day or two, that could probably will get a big follow through down here. And then on the bullish side, I mean, we're under this resistance area now. So it's this resistance area, this one, this one, this one. It's a lot of really tight resistance areas to get through on the bullish side. And then in general, if you get up here north of this 2-year bull market average or this bull market support line, this is actual bull market territory where it looks like a long-term bull market. And then down here, you have to get below this and break down to get into bear market territory where it would look like a long-term bear market. But as for the last several weeks or month or whatever, we've been sort of in between bull market and bear market territory, just kind of wobbling around in a space that hasn't made a whole lot of sense. Like the fundamentals and the trading prices have detached, and there's no indication of if and when the fundamentals are going to come back into play. And I mean like the Warren Buffett fundamentals, like the price, excuse me, like the price to earnings and those sort of things. Right now are just not really affecting the market trading. The thing that is driving the market trading the most is the liquidity that everyone says the Fed is pumping out like crazy. But if you go look at the Fed's balance sheets, they have been going down for almost a month now. And there's very little Fed liquidity coming into the markets at this point. And the markets, they haven't really been going up. Since pretty much the Fed turned off the spigots like right around here, and we've just seen the market trade sideways ever since. It's just a minimal amount of Fed liquidity, well, relative to the trillions they were pumping in before. They're just pumping in a few billion, not a few trillion at this point. And yeah, and so we've traded mostly sideways from that point, and that's where we're sitting now. And I don't think the Fed is going to try to pump a bunch more money until there's a reason to do so. So I don't know what to think. It's pretty hard to predict what the market is going to do at this point because we're not getting good technical setups. It's not following fundamentals. The liquidity that's been driving it is not there right now. And so if we do get like a big liquidity push, like it probably will drive the market, but we won't see it until the end of the week. So you could get a trend for 3 or 4 days before you even see the liquidity that was related to it. It's kind of a hard thing to try to use as a forward-looking signal. But yeah, that's it for right now. Just on the technicals, this is a bearish looking setup at the moment, and it needs to actually break down. It needs to actually break down here before becoming a bearish kind of technical entry point. And yeah, so that's that kind of look. I could flip through a couple other things like the DXY. Relative to the financials, the DXY breaking down would be an inflationary indicator that would probably end up being better for financials, but the DXY is still holding above this 10-year support line, so it doesn't look like it's breaking down to me. It has broken down relative to the past couple of months. It made a move down, but relative to like the last 10 years, it's still on the same long-term support line. And then the bonds are starting to break down, which would be very bad for the financials. That'd be putting downward pressure on the bond yields and on the Fed, like for the Fed funds rate. If that starts trading down, the Fed might have to come out and announce emergency rate cut, and they're already right next to zero. So what are they going to cut to? They really don't want to go to negative. It doesn't sound like it. So yeah. So for now, there's not a lot of reaction to the earnings reports coming out, and we haven't got a break on any of these leaders. And the XLF is one of the leaders, but it has not broken either. So those are the main things I'm looking at now. The Fed liquidity is still just stalled out. But as far as the charts go, the DXY has not broken down yet. The bonds almost look like they want to break down, but they haven't broken down yet. The Qs have made a little pullback, and it's not much of a pullback, but it hasn't broken down. If the Qs break down, that would be a big one. And so those are the things to kind of watch, I guess, over this week to see if we get any of these things. And if it leads, like, well, what's the yen doing? The yen is an interesting one that'll kind of move before the DXY moves sometimes. Nothing. So yeah, we're not really getting signals that anything's going to try to move anywhere at the moment. And same thing, from the financials in general. We're getting bad earnings reports that are better than expected, and it's just kind of sitting. It's just kind of sitting still. So uh, yeah, so we'll keep a look. We'll keep a look at these earnings reports and see what is. Oh yeah, this gets weird. I don't know why it does this. It's just like if I'm on the hourly view on the financials, it just does this jump from September 19 to March 2020. I don't know why it does that. All right, I think that's a good enough look here for Citigroup. Um, Bad report, weak stock chart, but it doesn't really have a setup to make a break in either direction that I can see at the moment. It looks just like a wait and see kind of thing. And that goes for the financials as well as the whole macroeconomics, inflation, deflation situation. Just don't have a signal that any of these things are happening right now. And maybe that's kind of a good thing. As far as like the Fed and the Treasury go, like they don't want inflation to take off. They don't want to get into a deflationary situation. And right now neither one looks like it's happening. So I mean, from the government and the stability of the monetary system standpoint, that's all probably a good thing. Um, but as far as trying to look for an environment where a certain type of trade will make sense, like if you want to look at silver or if you want to look at, going long on a certain sector or something like that, you want to see, you want to know what the trend is. We're not getting any kind of trends. We're just stuck in this weird zone right now where none of the trends are setting up yet, but it should be pretty soon that we actually see things start to break one way or the other. So in the next week or two, we should be getting some trade setups that make sense. And yeah, and these earnings reports, this should be interesting. Like I think the rest of the banks are gonna be kind of scary. I think Wells Fargo is coming in. So let me go see if we're getting any other earnings reports, and I'll check in soon. And happy trading.